This is the volume profile, and it can give you profits so insane that the moment I started applying it into my trades on derivative volatility pairs, I instantly started flipping my small accounts effortlessly. And after watching this video, you will not only know how to use the volume profile, but will know all of my secrets on how I use it personal to flip volatility pairs on small accounts. And at the end, we are going to look at a V75 entry that took my $100 to $60,000. All because this powerful indicator gave me the signal. Now, I just opened my Telegram, which I'll be sharing signals, trade outlooks, strategies quiz, and a shit ton of value. The best part is, it's completely free to join. Want to check it out? I'll leave it in the pinned comment. I'm sure most of you see normal volume strategy everywhere on YouTube. It's easily one of the most overhyped indicator for volatility index. You get a huge volume bar on a big candle must mean something important happened, dope, except you're wrong. Here's the flaw with normal volume. While yes, it could be somewhat useful, normal volume is just based on time intervals. The default value at the low of your chart tells you how much was traded that day, but says nothing about what prices the real buying and selling pressure is occurring. That means every single day you're likely spamming entries at the exact price levels where market movers are offloading. So the question becomes, what if you could see where the volume happened, not just when? What if every single price levels have its own volume bar attached to it, so you could instantly see which prices market movers were actually interested in? And that's where the volume profile comes in, which is basically just a normal volume indicator but flipped on the side. So now, instead of seeing volume over time, you now see volume per price level, and see which price levels have the highest amount of liquidity. And if you're thinking like I'm thinking, we can use this to our advantage. But first, go to TradingView, and if you don't yet have it, I'll leave the link in my description. Go to the Indicators tab, search Volume Profile, and make sure to choose this fixed one right here. Once you've selected it, go to the Tool Settings, and toggle on Volume Area High and Volume Area Low. This is very important. Now, throughout this uptrend, we can easily see where the strong points of interest are. In this uptrend, we can see areas with high distribution of volumes, and we can see areas with low distribution of volume. In other words, a lot of trading happened in this areas, and less trading happened in this areas. Usually, area with low amounts of volume means one side of the market is dominating the other. So, either buyers or sellers are clearly winning by a landslide, and price isn't there for very long, which is why there's low amount of volume. And areas with high amount of volume means that there isn't such a clear winner, and there's a big ongoing fight between the buyers and sellers. To give you some sort of price action examples, it would often look like this. So, here we have low amounts of volume, then we get high amounts of volume, and then low amounts of volume again. So price will most likely look like this, where it's spiking up fast without a lot of hesitation during this low volume areas. Then the moment we start hitting high volume areas, price would likely consolidate and start moving sideways, spending a lot of time here, which is why there's a lot of volume. Then we start hitting the low volume points again, where price starts again moves freely without a lot of hesitations. So, to put it simple, price will have big spikes in low volume areas, and would consolidate more in high-level areas. Which can be used just this in itself. You can easily predict what price was about to do. When using the volume profile, you'll have three main lines you need to pay attention to. This red line, which is what is called the point of control, which in other words is the point in this uptrend that have the most amounts of volume or the most amounts of trade was active. Then you have the volume area high represented by this line, and the volume area low represented by this line. In between this line creates this zone, and this zone is where 70% of all volume was traded. And if you use it correctly, it can show you where big money is likely entering and exiting. So for example, say we have this volume profile, which consists of volume area high, volume area low, and point of interest, which shows that 70% of trades happening in this area and anything outside this range would be considered an anomaly. Or, in other words, cheap prices market movers want to buy, or very expensive prices they want to sell at. Based on this trend historical statistics, so oftentimes price would go below the value area low for a short period of time, and might want to mean revert back to the point of contact and spend more time there, making this spot a great opportunity to buy. Same goes the other way. Price would go above the volume area high for a while because market movers would want to sell here, considering that prices are very expensive based on past chart history, and will eventually mean revert back to the point of contact. So a very simple high-performance strategy is to buy whenever price becomes cheap, like when it's going below the value area low, take partial profits when it hits the point of contact, take full profits when it gets too expensive. Or short, whenever price goes above the volume area high, then partial profits at point of contact, full profits when it becomes cheap. So this is the basically on how the volume profile works, and I even gave some hints on how to use it. But now is time to go for actual strategy on how to use it right now. And for this example, we'll use Volatility 50 Index because it's very volatile and a lot of people are making insane money trading it. And if you use the volume profile, you could have flipped your account before everybody else. But even if the volume profile will work on all time frame, I'll recommend you stick to 30 minutes above as a beginner. And what I like to do is to stick to the 4-hour above for stronger bias, because this stronger time frames would give clear, strong levels that institutions are watching very carefully. So for this example, we're going to be using the daily time frame. Now here V50 had a strong uptrend, and if you're using normal technical analysis, say supply or demand, you'll have a demand zone or your support zone here, 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 and here. And you really wouldn't know which levels will hold or which ones to trade. So you'll basically be guessing, but if we add the volume profile, it would tell you exactly where you need to be entering. So grab your volume profile, mark from the low to the high of this move, and again we have our 3 major high, our volume area high, volume area low, and point of control, and you can easily see that price consolidated a lot at our high volume point. You can see we have high volume here, price consolidate, we had another high volume at this point of control, price consolidated, and we had somewhat high volume around here, and same thing happened, and you can also see price spikes up fast at the low volume points. And also a key reminder, 70% of all trades happened between the volume area high and volume area low. And in other for maximum effect, you would want to buy around the volume area low or below it, as that is signaling prices is cheap. And it so happens there's a demand zone right at our volume area low, which is literally textbook. We wait for price to come to our volume area low demand below the line. And just look at this. Price spiked up fast, giving you insane profit. And if you look closely, it literally started at the tip and exploded up, but it keeps getting better. Because this is just the continuation entry. But how I flip this account is by caught both reversal, pullback, and continuation. So first you want to go to V75 Index on the daily time frame, and you can instantly see our volume area high, point of control, and our volume area low. Right now, price is around our volume area high. So we are going to take it that price is expensive based on past volume and would want to mean revert back to our point of control. So we enter a short trade to caught the reversal pullback, and that's exactly what happened. And since price came all the way down, it is now past our volume area low. We now know price is considered cheap based on past volume. So this time we enter a long, and yet again, price spiked up immediately exactly at the tip of contact. Not to talk of when you add price action concept. So if you want your account managed,